People often confuse portfolio and asset management, although these concepts are very different. Portfolio management seeks decisions on creating and evaluating the assets in the investor's portfolio. Asset management looks at the entire spectrum of personal finance on an individual level. Both branches of management tend to work on different levels. Is an asset manager the same as a portfolio manager? Well, asset managers do manage portfolios. However, unlike dedicated portfolio managers, asset managers can also handle cash and other tangible physical assets like land, property, and valuable items. Like an asset manager, a portfolio manager handles your investments and other financial products that make up your portfolio. While you control where your money goes, they put the money into the investment on their advice. As a team, you and the portfolio manager work to evaluate and reevaluate how your money grows and adjust your investments if needed. Also, like an asset manager, it's the portfolio manager's job to analyze the market and make the most informed decisions about your money and investments. Their guidance should consider your comfort with risk, expected returns, individual circumstances, and financial goals. In today's video, we're looking at the general overview of portfolio management versus asset management, so come with us. Portfolio management. A portfolio is a group of financial assets, including stocks, commodities, bonds, cash, equivalents, mutual funds, exchange-traded funds, etc. Portfolio management looks at making decisions regarding these investments and their appropriate mix. It looks at the asset allocation and balances the risk against the estimated performance. It determines the strengths, weaknesses, threats, and opportunities regarding the assets and their performance, and makes an optimum choice to maximize the return from the pool of assets. For instance, an investor has a certain amount of funds, and he intends to create a diversified portfolio to help leverage higher returns and lower risk metrics. A portfolio manager will distribute the funds across different asset options like equity, mutual funds, real estate, fixed deposits, bonds, gold, etc. The portfolio manager will do the bifurcation to maximize the returns while creating a basis for a lower risk pattern. It's pretty common to see portfolio management and asset management in the same breath, although they're not the same. Portfolio management looks at creating and managing the investment of an individual. Portfolio management is conducted by professional portfolio managers who oversee the portfolio on behalf of others, although plenty of individuals also build their portfolios and manage them independently. Portfolio management is guided by the goal to maximize the return on the investment bought by the individual while managing the risk to the lowest possible exposure. Generally, portfolio management can be either passive or active. Passive management refers to setting up a strategy and keeping it for the long run. It's also known as indexing or index investing. Active management refers to a single manager or a team of managers managing the fund on behalf of the client through investment decisions and research. Importance of portfolio management. Number 1. Portfolio management presents the best investment plan to the individual as per their income, budget, age, and ability to undertake risks. Number 2. Portfolio management minimizes the risk involved in investing and increases the chance of making profits. Number 3. Portfolio managers understand the client's financial needs and suggest the best unique investment policy with minimum risks. Number 4. Portfolio management enables the portfolio manager to provide customized investment solutions to clients as per their needs and requirements. Types of portfolio management. Portfolio management is one of the following types. Active portfolio management. As the name suggests, in an active portfolio management service, the portfolio managers are actively involved in buying and selling securities to ensure maximum profits for individuals. Passive portfolio management. The portfolio manager deals with a fixed portfolio designed to match the current market scenario in passive portfolio management. Discretionary portfolio management services. In discretionary portfolio management services, an individual authorizes a portfolio manager to take care of his financial needs on his behalf. The individual issues money to the portfolio manager, who takes care of all of his investment needs, paperwork, documentation, filing, etc. In discretionary portfolio management, the portfolio manager has full rights to decide on his client's behalf. Non-discretionary portfolio management services. In non-discretionary portfolio management services, the portfolio manager can merely advise the client on what is good and bad for him. Still, the client reserves the full right to make his own decisions. Portfolio managers. A portfolio manager helps an individual invest in the best available investment plans for guaranteed returns in the future. Let us go through some roles and responsibilities of a portfolio manager. A portfolio manager plays a pivotal role in deciding the best investment plan for an individual as per his income, age, and ability to undertake risks. Investment is essential for every earning individual. One must keep aside some amount of their income for tough times. Unavoidable circumstances might arise any time, and one needs to have sufficient funds to overcome them. A portfolio manager is responsible for making an individual aware of the various investment tools available in the market and the benefits of each plan. Make an individual realize why he needs to invest and which method would be best for him. A portfolio manager is responsible for designing customized investment solutions for clients. The portfolio manager needs to analyze his client, known as individual earnings and capacity to invest. Sit with your client and understand his financial needs. A portfolio manager must keep himself abreast with the latest changes in the financial market, suggest the best plan for your client with minimum risks involved and maximum returns. Make him understand the investment plans and the risks involved with each plan in a jargon-free language. A portfolio manager must be transparent with individuals. Read out the terms and conditions and never hide anything from your clients. Be honest with your client for a long-term relationship. A portfolio manager ought to be unbiased and a thorough professional. Don't always look for your commissions or money. It's your responsibility to guide your client and help him choose the best investment plan. A portfolio manager must design tailor-made investment solutions for individuals which guarantee maximum returns and benefits within a stipulated time frame. The portfolio manager must suggest to the individual where to invest and where not to invest, keep a check on the market fluctuations, and guide the individual accordingly. A portfolio manager needs to be a good decision maker. He should be prompt enough to finalize the best financial plan for an individual and invest on his behalf. Communicate with your client regularly. A portfolio manager plays a significant role in setting an individual's financial goals. Be accessible to your clients, never ignore them. Remember, you're responsible for putting their hard-earned money into something which would benefit them in the long run. Be patient with your clients. You might need to meet them twice or 3 times to explain all the investment plans, benefits, maturity period, terms and conditions, risks involved, etc. Don't ever get hyper with them. Never sign any important document on your client's behalf. Never pressure your client for any plan. It is his money and has the right to select the best plan for himself. Asset management. Asset management refers to developing, operating, maintaining, and cost-effectively selling assets. Most commonly used in finance, the term is about individuals or firms that manage assets on behalf of individuals or other entities. Every company needs to keep track of its assets. That way its stakeholders will know which assets are available to be employed to provide optimal returns. The assets owned by any business fall into 2 main categories: fixed and current assets. Fixed or non-current assets refer to assets acquired for long-term use, while existing assets can be converted into cash quickly. Managers often deal with 2 main concerns when it comes to asset management. The first is, what role does the asset management process play? Second, how can a firm develop a good asset management plan? Importance of asset management. There are several reasons why businesses should be concerned about asset management, including 1. Enable a firm to account for all its assets. The process makes it easy for organizations to keep track of their liquid or fixed assets. Firm owners will know where assets are located, how they're being used, and whether changes are being made to them. Consequently, the recovery of assets can be made more efficiently, leading to high returns. 2. It helps guarantee the accuracy of amortization rates. Since assets are checked regularly, the process of asset management ensures that the financial statements are appropriately recorded. 3. Helps identify and manage risks. Asset management encompasses identifying and managing risks that arise from the utilization and ownership of certain assets. It means that a firm will always be prepared to handle any risks that comes its way. 4. Removes ghost assets in the company's inventory. Instances that exist where lost, damaged, or stolen assets are erroneously recorded on the books. With a strategic asset management plan, the firm's owner will be aware of the assets that have been lost and will eliminate them in the books. Asset managers. An asset manager oversees the investment of the financial assets of a company or individual. While the title most commonly refers to financial investors, it can also apply to real estate. Let's go through some roles and responsibilities of an asset manager. Prepare financial reports and reconciliations to general ledger data. Monitor and report changes in the portfolio's risk profiles and individual assets. Make timely recommendations for mitigating strategies and risk rating changes. Monitor accounts and report on fixed assets and deferred charge assets. Prepare analysis, record, and report asset transactions for financial records. Manage and monitor team performance. Coordinate with fund advisors and direct partners. Monitor project and fund compliance with regulatory requirements. Prepare and review timely asset management reports. Prepare regular investment reports and risk assessments of investments. Execute corrective measures when early warning signs exist on performance issues. Benefits of asset management. There are many benefits of adopting an asset management strategy, such as improving acquisition and use. By keeping tabs on a company's assets throughout its life cycle, a firm owner can improve their technique of acquiring and utilizing assets. Improving compliance. Government agencies, nonprofit organizations, and companies must provide comprehensive reports on how they acquire, utilize, and dispose of assets. Most of them record their asset information in a central database to ease the reporting process. In such a way, they need to compile the reports at the end of their financial year. They can then easily access all the information they need. What else? We beg to end the video. Be sure to like this video and share it. And if you're not subscribed to our channel, please do so. And don't forget to turn on the notification bell for timely updates on our new uploads. We value your feedback, so please share your thoughts with us in the comment section down below. Goodbye.